What did the markets see this week, and how did they react to it?
So I think what the market has seen really in the last couple of weeks is a change in the near-term trajectory of the economy. And you can really go back to the early September time period, up until which we had seen such dominance by the big five names, that concentration in parts of the market that were seen as the only COVID beneficiaries. And at that time in early September, there was more than a 60 percentage point spread between the big five and the entire rest of the S&P. Then these series of rotations started. It really kicked into high gear in early November, out into areas that hadn't worked, into much more traditionally cyclical areas because of the vaccine and pun intended, the shot in the arm that meant for the economy. But then by virtue of the virus and seeing the weaker economic data, retail sales, the December jobs report, I think we've seen this reversion back to those kind of stay-at-home stocks, what have been this era's defensive stocks. And I think that helps explain what has been this ongoing conundrum or question about the perceived disconnect between the market and the economy. Looking under the hood of the market, those rotations, I think, do reflect what's been going on in the economy.
So take us forward to next week. We've got a lot of big tech earnings out. Is tech fully valued at this point? What are you expecting? Will there be a continued move into tech?
It depends on what tech you're talking about. I think there are some, extraordinarily expensive names within tech. We have a market perform rating on tech, which means sort of stay in line with market levels. We think it's probably a little rich broadly from a valuation perspective to kind of press bets on the outperform side, nor do we think you want to be underexposed, because that's really where the growth drivers are. I just think in this environment, whether it's within tech or other sectors, be them on the growth side of the spectrum or the value side of the spectrum, I think what's going to work in this market is actually a bit of a hybrid approach, almost what we used to call GARP, where you want companies that have those growth characteristics, strong balance sheets in addition to that, but you're not paying nosebleed valuations for them. And I think that blended strategy within tech, but in other areas, is going to serve investors well this year.
Listen, how much froth do you think there is in the market? We had Jeremy Grantham tell Bloomberg this week he thinks this is the worst bubble since 1929. And he's something about perma-bear, but at the same time, you've got Bitcoin all over the place, shooting up over 40,000 and dropping back off. And you also had at the very end of the week a remarkable circumstance with GameStop shooting up on basically retail investors, as far as I can tell, buying calls.
I think there are micro bubbles, and they're a function of the newly minted day traders, the retail traders, as you talk about, and the fact that they sort of move in and out of certain pockets of the market, be it in cryptocurrencies, certainly in call options, naked call options. Until a couple of days ago, you were seeing the best performing stocks being less than $1 at the start of the year. So there's also been this trend to not cheap stocks from a valuation perspective, but low price stocks. But I think it's a function of that rotation, and you can see some of these micro bubbles actually get pricked and some of the air come out without taking the entire market down with it. So that, I think, is the differentiator between an environment like today versus, say, 1999, 2000, where the bubble was in the most dominant names, in the most dominant indexes, the S&P and the NASDAQ. And that's why when that bubble burst, it did take the market down with it. I think we could continue this process of rotational corrections that maybe hopefully eases some of this speculative fervor. That doesn't mean it's not going to find another place to go, but may not be the kind of systemic thing we think about when we go back to, say, circa 2000.
I wonder, Lizanne, if that takes us back to the earnings question in some sense, because you've contrasted 1999, 2000 in a situation where both price and earnings were going up. This time, earnings still have a while to come back. Do you expecting earnings to really rebound here over the next year or so?
Well, and that is the difference, because earnings and prices were moving up in 2000. It's just prices were moving up at a much more rapid pace. And we now know, with the benefit of hindsight, earnings were rising into a peak. Clearly, what at least initially drove the PE to shoot up was the collapse in earnings. Now we're looking at an upswing into earnings. So far, if we look at the pattern from second quarter, third quarter, and so far in fourth quarter of record beat rates, that could mean that the estimates that are in place for 2021, which really start to kick into higher gear in the second quarter, simply because the comps get easy. You're talking about year over year relative to the lockdown, the shutdown phase during the pandemic. Yeah. I think there's a risk in turn if those estimates prove to be too high, but there may actually be an opportunity for a better improvement to valuation if those numbers are too low.